Please go right ahead. Please.
I wish I was on the previous panel. So I can contend to everyone, to everything that they say, because it seems like today everyone is painting the family office, single or multi-family office, all in one color. As if a family, like our family today, we account for 462 people. They are not all in finance. Our millennials are not all in finance. Some of them are doctors, some are engineers, some are artists. And today there is a phenomenon in the family office that nobody want to talk about it. And we were discussing this in Europe. There is a rate of suicide. There is a rate of kids saying, I don't want to be rich. I don't want to be in the family. I don't want to be governor. I want to look at the Prince of England. I mean, you guys don't need to believe what I'm saying. This guy, he left the family that rules England. And he said, I will give up my title and everything. He is from a family office. So this is very much repeated. But today, the conversation with Rosario is about real estate and hard assets. My name is Kamil Homsi, and I run the GRC Investment Group, which is a single family office in its fourth generation in Dubai. And I do take a special affinity to governance, to the structure of the family, and also to the succession, to mentoring, and to preparing those millennials that are great people to be great leaders of the future. So we focus on alternative investments on a global platform of investments today from Australia across Eurasia, that's the new term between China and Portugal, inclusive, and also in North America. We have a limited amount of investments in Brazil, Colombia, and in Mexico. We also invest in renewable energy, those that are nascent and others that are a little bit advanced. And we also invest in waste management. We are opportunistic in nature, and we keep offices, again, as I said, in Dubai, in Singapore, London, and here. I've been spending a lot of time here due to COVID. I'm happy to be here. I'm always happy to participate in Marty's events for how educational and valuable speakers that he invites. Thank you very much, Marty. I'm happy to be with everybody here.
Excellent. How do you follow that act? Family office of
We've been on panels together in the past.
family office of two. Just kidding on that one. And that's BlackRock out of Structured Products. 2008 decided that it was the right time to start a new era on firm, if you will. Primarily move away from public assets to private assets and build out the structured finance platform at BlackRock, including the advisory. So we managed to be able to show that transparency and getting really understanding the collateral was really very important, and that really helped us to NewOak was born to in fact be a partner with large institutional investors as well as the banks to help them out to figure out what happened after the previous COVID, which was 2008.
Which was much
It was
worse.
a different pandemic, but it was
Yes.
a pandemic. And so, as Marty was saying, we got a chance to look at over 10 trillion in assets, underneath as part of whether it was litigation, it was repositioning, whether it was reevaluation and figuring out really where things are. So we started as an advisory in general. We got into when non-QM mortgages started as single family, we decided we want to be a little bit different and even more crazy. So we went through our first strategy was super jumbo single family, which has actually performed as an asset class incredibly well. You'd be surprised how many people write $50 million checks for residencies, and also don't mind what they pay on interest rates. So that actually helped us to team up with a post-retention plan and get that off the ground. And so as far as real estate is concerned, our biggest project is a Bahama ESG zero carbon, a billion plus, single island resort that we've been working for quite a bit of time with the developer. So we work really with, we're very theme-based on the real estate side. We're on the general interest rate, real estate, we tend to be on the valuation side of things and really evaluate whether, we look at underneath the CMBS role, we get quite a bit of access to the underlying, large number of assets and how they perform, and that's, and you haven't used that database of the CMBS, it gives you a lot of information that you don't otherwise get on the debt side. So generally speaking, right now, single family rental is one of our biggest focus, and cannabis property debt to non-operators, to the REITs
We'll
is.
get into the weeds of those
That's true.
things.
So you're doing cannabis lending?
Yeah, we actually have a team focused primarily on lending on cannabis.
That's been a great space for our group, sure.
Right.
Yeah.
Then we have some of the panelists. Johnny, you wanna go ahead?
Hi, everyone. My name is Johnny Sue. I'm the CEO for Recap. Recap started as the finance division for GMAC Real Estate. Since 2006, I've been running the division. We've done over $2.8 billion in loans. We're generally known to do more out-of-box type of deals. We really are commercial real estate focused. So anything hotels, a lot of condo construction, a lot of special use, but pretty much do every type of real estate. Most recently doing a lot of industrial property, doing a lot of vacant properties. Most of our clients are ultra high net worth, some family office, but mostly are high net worth individuals.
Peter?
I hope everyone's doing well. My name is Peter Powers. I'm a second generation member of MPI Family Office. We're a family office based in St. Petersburg, Florida. I wish I could be in New York with all you today, but unfortunately I just had some other travel obligations. But feel free to look me up on LinkedIn and we can connect there. Just look up Peter Powers. But I'm a second generation member. My father and uncle started the family office about a decade and a half ago, and I've been running the real estate platforms for the last couple of years. We're primarily in multifamily, self-storage, and senior housing. During COVID, it's our portfolio got shooken up a pretty good bit, but we've been just kind of growing two platforms. One of them is our hotel to apartment conversions, and the other one is our low-income housing tax credit acquisitions. We see a lot of opportunity in the affordable and workforce housing space, and just given again there's an affordability crisis. We really believe putting more dollars into that space is a smart way to again kind of provide housing, but also provide great returns for our family.
Do we have anybody else?
I think that's it. I haven't been on reach list.
So, going back to what my esteemed panelists were saying, I agree that 2008, 2009 was a much far worse tsunami for real estate than the pandemic. Because obviously there was no government, they didn't have any kind of, except for QE, we didn't have any, support. So everybody for themselves, and you were able to find the greatest deals in one generation, like the HSBC building down by on Fifth Avenue by Bryant Park, just to mention. Anyway. But there's been a lot of trouble here and there. For instance, in New York City, we've had to deal with some retail tenants, especially restaurant and hospitality players who couldn't work. They were shut down and they couldn't pay rent. So everybody suffered. We had to kind of rework everything out, do a percentage rent which is not typical when you deal with small tenants. Now, how did you all, this is a question for everybody, how did you navigate throughout this period? What kind of challenges did you face? What did you do to overcome them?
Are you,
And I'm sure you have too many because you deal with too many things.
do you have, are you referring to the period between the last meltdown and now? Or
No, I'm
comparing
referring,
with-
you can compare it, that's fine. I mean,
Right.
comparing it to
For what you
the
said.
financial
for what-
crisis and COVID, yes.
Sorry. For what you said, Rosario, what protected the real estate this time, and for two men that we must accredit, their names were Christopher Dodd and Rodney Frank.
Mhm.
You know, the legislation that they wrote, that they limited the extending capital, and also regulated the commercial mortgage and including the residential mortgage, did protect us this time. This time we had regulation and we had plenty of capital. Okay? The only thing we had a freeze in the economy. So there were opportunities. I capitalized on opportunities in 2020, where today I find most assets are, especially commercial real estate, are overpriced.
Yes.
But during the first,
There are no deals.
during the panic period, until, I mean, not only the COVID and then the demonstrations in the street and the moratoriums that were passed by the previous administration and then followed by the new administration, where every agency in the government had the right to pass moratoriums. I mean, CDC had a moratorium, and then the government will have a moratorium, some local judge will have a moratorium, and many real estate investors capitalized on this. So that's one. What you manage is, you know, the way we managed, immediately, we froze a lot of the expansion and brought most of our asset and property managers to Zoom, I can't say table anymore, to Zoom, to where we tell them, look, we have to maintain a healthy environment within the assets. We will stop hiring, and at the same time, we established a norm, not across the board, for different assets in different states, how to deal with the tenants. Like you mentioned, Rosario, there are tenants that were heavy, there were states and municipalities that were heavy in moratoriums, while others, they were more lenient and more soft. And even as a landlord, and even as the asset owner, I do sympathize still today with the tenants. Of course. You know, some of my friends are judges and attorneys, and they say, you are among the few. I said, I'm sure there is more than a few, because landlords are human and they're family people. Some are strapped with expenses, or they were spread thin in those who purchased on Fifth Avenue in 2017, and they paid $5,000 a square foot, and then they immediately inherited 3 years later a building that's 80% vacant, and the other 20% are not paying rent. I mean, they called the bank, and we had opportunities like this offered, and one of the assets that we bought on 48th Street in New York was among those, where the note holder called and said, Kamil, do you want the keys? Yeah. And honestly, when I approached the owners, because the owners also known in New York, I offered them a capital injection and a new valuation to come in with them as an equity partner. But they were too proud. I even offered them, keep the management company. You know, you will not lose face in the market. You will not lose credibility among the creditors. They were very much stuck to the vintage and said, no, we are not going to do it. We want to walk away. So, okay. Was it bought on discount? Definitely. So there are many ways to manage. Now, assets in Florida and assets in the Carolinas in the Mid-Atlantic, they were managed differently. I'll stop here for the benefit of my colleagues.
When you're in single family debt side of things, we were initially worried that the specific asset class we were in, super jumbo, single family in prime locations. Our portfolio was not affected, fortunately, so that's from a portfolio point of view. From the opportunities that the assets we were working toward developing, which is the Bahama Resort that I was mentioning, the ESG and the having some insulated places for rich families to be able to go during times like this, to be able to insulate themselves from the world, but still be very near civilization. That we found actually extremely attracted more interest even from other localities globally where they really were dying to get out. They were dying to get into a place where they could actually walk in an open environment, take the boat out, do whatever they need to do. So again, as was mentioned at the very beginning of this, there were different asset classes. Real estate is not as location, and use. So you've always got to look at alternative use. And as I highlighted also on the cannabis lending side, that machine did kind of stop. We're going to still putting that. There were more states opening up for that for medical or recreational use. Again, we're all dealing not with the operators, with the real estate owners. So those assets were substantially higher than your other industrial assets, if you will. Ended up actually attracting more interest in investors that are interested in investing in debt. And with the prospect of interest rates staying low and you can make 8, 9, 10% rate with 150% debt service coverage and essentially hyper-amortization of those loans. There were people who wanted to make essentially more. We're definitely looking at it. I think the posture also was changing toward potentially federal legalization of the asset. The banks were allowed to actually, they don't have to use, the tenants don't have to use the cash anymore. So that environment continued to suffer. So that's where our perspective was going. The hockey puck is going to be not what it is, and it looks like similar to the view. I think that opened up opportunities for us to talk to.
You have to be flexible.
Yeah. And real estate is a long-term asset. You don't think of it. And again, use can always be changed. Because office can be, or hotel can be changed to something else. And I actually think with people working remotely, the business hotels are even going to pick up at some point because people still have to gather and they have to move, and they're going to do it more in these type of situations than actually do it in offices.
Peter.
Yeah, so I didn't hear the question clearly, but sounds like kind of what happened during COVID. How did things change? Is that kind of the question? Can you guys repeat it? Okay, good. Well, I guess I can give it from 3 different perspectives. So from the self-storage side, we kind of weathered it pretty easily. That's not a huge part of our portfolio, but we do own a couple thousand units of self-storage. I mean, we did pretty well with that, and people paid consistently. It's not a huge payment for a lot of people. It's $100, $150 a month. They continue to pay for it because they have their possessions there. They know if they don't pay that, those possessions could be auctioned off. The senior housing space, that got hit really hard. We own some in New York and Pennsylvania. We own some in Tennessee. We own them all around and love to own some more. Kind of the background of our family is we were in the healthcare sector, so we understand the seniors very well, and we really like senior housing. We think it's going to continue to grow, but just during COVID, there was obviously people dying, and there were not a lot of people coming back into the communities because you were hearing some of the horror stories of what was going on. So you have essentially an open back door, but the front door is closed. So our occupancies really dropped. Now I'm happy to report that as of say Q2 or Q3 of this year, our occupancies and our started to rebound in our leasing traffic, our residents moving in was up to 2019 levels, and we're doing pretty well now on a lot of our properties. But there's I mean, we didn't experience it as much, but there's definitely some groups out there that may have just been opening up a senior living facility and they were going through lease up. They definitely got waxed. I know we had one of those, and it was difficult for us, but given that it was very specific, it was memory care. Those people definitely they need to move in and they need the assistance. On the multifamily side, we own about 6,000 apartment units across the country. That space really got hit. We're in various different states, about a dozen or so states, and some areas were better than others. But again, it comes down to you got to work with the residents, which is what we did. But there was definitely a good handful of them that game the system, and they would hold out, and we saw it on some of them where we would right when we were about to take them to court, they would write a check for $5, $10, $15,000. So they had the money, it just they were holding on to it. So we did a really good job in terms of the management. We understood how to reach out to all the various different agencies, and we were very proactive with it. Every single day you just need to hammer away. So that was kind of our philosophy there, and the operators and the partners that we have partnered up with, we did a really good job, and it was a good year. There was a lot of opportunities, out there. But I mean, I guess compared to 2008, I mean, a lot of assets got hit hard, but I mean, prices they might have went down for a quarter or two, but they were back up to record levels by the end of last year. By the middle to end of last year. So I think that's what saved a lot of people in the commercial space as well as the single family space, just because their homes were worth a lot more. So the lenders weren't, I don't think, as frantic as they were back in the global recession.
That's what saved the Hamptons. Johnny, obviously you have a different perspective being on the capital lending side. What issues did you have? Did you have any opportunities to maybe go in, restructure, or maybe take a piece of a deal, or try to act on opportunistic situations? You're muted.
Johnny.
Welcome.
I think what Peter said, echoes with a lot of deals that we've seen. But I think that one of the reasons why this time the price didn't go down that much, or there was a lot of people saved, because of the foreclosure moratorium, that the lender were told to give the borrower more room to work with them. So it wasn't a big pressure to foreclose. So there was really no one basically rushing out the door. So there was no stampede. Whereas last time we saw a stampede where, every lender was trying to get out and made whole. And then at that point, then a lot more people lose money. We did see a lot of client that was over leveraged or wasn't prepared. And we had to help the client recapitalize some of his property. But generally, we've seen a lot of people that was in distress, but because the lender was working with them and then foreclosed on them, and that buy time allowed them to kind of save themselves. But I still see, a lot of the clients are hurt. A lot of clients are hurt, but they, I think that, New York, we still have the foreclosure moratorium until January. But, just looking at the mass foreclosure that wasn't stopped by the court, you could see there were record volumes of, UCC foreclosure already. So had the court been open and had there not been a foreclosure moratorium, and the lender was told by the regulator to kind of, be realistic a little bit, I think you would have seen the bloodbath, because I think this time it came down a lot harder. A lot of asset was hit, even the safe asset like multifamily. You're seeing a lot of vacancy on multifamily. Almost, I would say from the client that we talked to, almost 75% of the retail tenant was not paying. So, you know, you had pretty much every asset type was hit. The hotel was decimated, but you know, the lender has really been working with the borrower this time, and there's no pressure to foreclose, or you really would have seen a stampede.
Agreed, a lot of the foreclosure act, I mean, not even the auction were UCCs from mezzanine lenders. But this forum is about how can people make money in real estate. So we want to switch the conversation a little bit and tell people how we can make some money. So, Kamil, where you see opportunities in the States, overseas? What kind of assets you're focusing? Are you seeing new trends? Tell us.
This panel is about hard assets as an alternative to commercial real estate. And hard assets can be categorized in various categories. But due to the fact today that we are living in a low interest environment, real estate is the main target. In answer, Rosario, to your question, I'm not sure beating around the bush. I do look into secondaries. And secondaries today, and especially for those who are familiar with the community of the high net worth, family office, single, multi, based on their AUM and the size of their back office, can look into this and also get borrowers. Because most high net worth and single family offices or vintage families, they don't like to publicize the fact that they own 15 or 20% in an asset around the corner here on Madison or Fifth Avenue, and that they want to sell. So they're active secondary brokers today in New York and in many gateway cities. They would reach out, for example, and I'll give you like a scenario of what I go through, and then when XYZ broker called and say, Kamil, you are in New York, I got a great deal for you. I said, does it meet my form? And for those that know me, they know the form. Is there a divorce? No. Is there death? No. Is there a change of lifestyle? You know, a family that do timber and now they want to do tobacco, or they want to do real estate, or they want to do fintech, or is there an internal dispute within the family? You know, two brothers, cousins, second generation. And if all four answers are no, why are you calling me for? Because when I buy secondary, I'm looking for a discount. And the discount is based on which one of those four is on the radar. If it is a Bezos divorcing his sweetheart wife for many years, you know, before she walked away with $65 billion, that could be an issue because she must have hired the best law firm and he did the same and whatever. We don't want to waste time on that. The opportunity is one opportunity at a time. So in that case, every opportunity is a silo. There is no such thing as, you know, let's all paint them together. I can buy 500 Fifth Avenue, the corner of 42nd Street, for the same deal that I would buy within the vicinity of the Trump Plaza. No, each one of them has its own circumstances. So that's on the secondaries.
Location.
Yes, and also the circumstance around the need to sell. You know, there are foreign governments whose ratings has been reduced at the beginning of COVID. So they were no longer able to borrow more money to service their existing debt or to borrow more so they can buy vaccine and they can buy the PPE and other supplies to also service their own people. And those are accounted about 80 countries. Many of the rulers of those countries, they own assets in gateway cities in the United States of America. So all of a sudden, they were desperate to sell. Those were opportunities.
W Hotel in Washington, D.C. Which I think was a great deal.
Absolutely.
I mean, wasn't priced at a discount,
Absolutely.
but when you look at it, a great property that you can buy without management, totally renovated on the corner, buy them all, you can't go wrong. So shame on those who didn't buy. Flat out.
I think that's definitely a distinct style of investing, but in the business that we're in, we are evergreen. We need to be effectively thinking about how to create value. So in that case, you're going to look where the market is going and create value. So we would essentially team up with developers who are thinking of locating gems within the neighborhood that can actually get the right entitlements. There's quite a bit of, I don't know whether you're interested in Boston character has changed quite a bit. There are a lot of industrial assets that are now being turned into mixed-use communities. You should also know that there is a huge move in the US to put lots of money toward a different way of creating community development support, meaning that what we are used to project finance or project, projects, they're thinking of more inclusive, more community-based that has both social as well as, provide home as well. So, they're planning a government program that is trying to address the lower income families and less fortune. So that's another area. I think the idea of theme-based, lifestyle-based investing is definitely important. And don't forget, there is a whole category called real estate tech. If you really want to get huge multiples, there's a lot of technology companies that we're focused on, whether it's working on the mortgage side, whether we're on the valuation side versus on the property management side. Proptech is a very big area, and I think we talked about titles. Why should there be a title company altogether? Right? Ultimately, in today's technology should be able to.
Blockchain, you don't need, yes.
But it's not going to come tomorrow. But it's going to, because there's going to be a huge amount of resistance to it.
Lawyers will make money.
But
Usually
your
title companies
positioning,
have lawyers,
right.
so that's a big problem. So
If you want
you mess around with accountants and lawyers, and that because it's a problem.
If you're trying to get 100x on gross valuation, that's where you go.
Absolutely.
I mean, forget about 3 or 4.
Can I just, you mentioned PropTech, but I mean, so PropTech is known for, meteoric rises and meteoric falls. And what was the name, what was it called? Realty Mogul, was that the one that was it? That was like huge valuation and then just crashed. Better did the same thing this week, well, Zillow's a whole nother issue. They had the overuse of purchasing properties in Arizona or something like that.
Mispriced properties and purchasing.
Right, so over-reliance on.
The problem with Zillow is very simple. Real estate is location, location, location. You cannot have a computer program algorithm buying real estate for you. You need to look at it. It's not like you buying a stock. You're buying real estate. You have to look at it. And if you probably don't remember, but when we had the financial crisis, we had, the mortgage-backed securities. If you would look at one of those things, you would have an awesome property on Fifth Avenue.
It was amazing, I
Then
remember.
you would have a garden apartments in Kansas City, land somewhere in Alaska.
Actually,
In other
they're
words, you had assets that didn't make any sense together. So they took people for a ride. It made no sense. That's why you have to know what you're buying. You go to the grocery store. You want to buy tomatoes? Look at your tomatoes. Okay? Otherwise, if you buy lemons, buy lemons. That is the issue with real estate. And I think that Zillow made the mistake thinking that an algorithm could do it.
So the issue with Zillow was the.
Well, let me add something. So we own about 6,000 apartments. I just was on a call with one of our operating partners, and we were talking about how we have this daily pricing system and how great great the system is. Because not only is it's looking at supply and demand, it looks at supply and demand for the whole market. Now, if you own something like that, if you own that software, so there's two of them right now for apartments. One is LRO, the other one is I forget what it is, but they're owned by the same company. If you have access to that data and you can see all the communities and you know, oh, they're bumping their rents 15%, they're bumping theirs 12. You're looking at all this and you kind of that data is ultimately what's going to help you drive those decisions. So, I mean, kind of playing the devil's advocate, if you start seeing apartment communities, and you're like, wow, they're really low on rents. They're not using our system, and I can optimize it using this rental software. I think it could drive investment decisions. I think it could help you drive the actual investment. Now, the actual valuation of it. I mean, again, if you see some of these apartment communities pushing up their rents like crazy, and you see where their rents are, you can get an idea of what type of price you could pay. So we're using that right now. I'm not saying we're using it to buy communities, but we're using it on our current communities to push up our rents, and they're pushing up renewals. We're usually push them up. We feel happy 5 to 7%. They're pushing up 15 to 20% right now. Like it's so efficient. You're like, okay, rent should be $1,200 to $1,300 this week, and they are for half the week, and then it jumps up to $1,500. And guess what? You lease the unit. It's doing it every single second. So those decisions, that data is what's going to help drive more and more efficient decisions. But at the end of the day, you look at something like that, especially with apartments. There's going to be a certain point where it's just not affordable anymore, and that's why we've really gotten into the hotel conversions, where we're buying discounted extended stay hotels and converting them to apartments where our rents are, typically let's call it 20 to 30% below. Yeah, the units are small, but they're very well located, have great amenities, and it's a great community. So we really like those type of assets. But yeah, technology is just over the last, probably 5 or 6 years, especially with the multifamily side, technology has changed everything dramatically, especially on the the rental rate side.
And can I make a quick comment, Pete?
Yeah.
So we had a speaker last week in Miami who has a proptech company that is a brand overlay on Airbnbs, vacation rentals, VRBOs, HomeAways, etc.
Yeah.
And so what they do is they own no property. They just provide an overlay of services that give you a white glove perspective, right? So they came to us, they just opened a round for like $1 million the week before, and they actually closed it at dinner. So in 1 week, this proptech firm who has an overlay on Airbnbs in terms of value add, it gives you kind of this, as I said, white glove perspective. They closed the round in a week, right? So, it seems like there's all these areas where you can add value that people aren't thinking about, and then boom, it happens.
A lot of it is in the rental data, which is really the income side, and that technology for especially residential pieces was not as firm. Now the data is widely available, and properties are being rented essentially on the website. The data is there. You can, so that gives you a sense of sort of
Yeah. And then one more thing I want to add. I was at an apartment community yesterday in Virginia, and I was meeting up with a general contractor. It's probably got one of the most innovative construction businesses I've ever seen. How he's using lasers and stuff to model out the rooms. But we're also going towards a point, and this really happened. It was happening before COVID, but it really gained a lot of speed and a lot of momentum. Was the virtual tours on these apartments, where you can really tour them, just by going online and looking at videos. And they're at a point now where they'll laser out the whole entire room, where essentially maybe you go into a leasing office and maybe they own 15 properties in the area, and you could tour 20 different units in 10 minutes. Where you put on the VR goggles, you walk around, you see everything. You can kind of see, okay, I can put my couch here that I already have. I can put this over here. And that's really impressive, because that's going to really cut down on payroll costs, because you may not need necessarily as many leasing agents when you can have just a few of them, but they're using the technology to kind of subsidize what another person would be doing. So I saw that, and I knew it was coming. I mean, I kind of pay attention to some of that, but to actually see it in the flesh was crazy.
Well, Peter, in support of what you said, today, the 3 leading wealth management companies in the country, naming BlackRock, KKR, and Colony, what the volume of single-family houses, not only apartments.
Uh-huh.
They invest in lots of 1,000, 2,000, 5,000 single-family houses at a clip.
Yeah.
Using proptech. And
Yes, yes,
wealth managers on
Uh-huh.
75 Park Avenue, they are
Uh-huh.
up to 15 states to close the deal in 1 week.
yes. There's a group out of Tampa that's doing that right now.
You
Yeah.
know, checking the real estate,
Mhm.
when you buy volume, you cannot afford to do them one by one, you're buying in bulk. What you do, you use the brand of the wealth manager and you use a deep discount and cash payment. And
Yeah.
that's where you make the seller bend.
Yeah,
And
technology is, yeah, I agree 100%,
they
Kamil.
use technology.
But I-
Yeah, and I have a group, there's a group out of Tampa they did that coming out of 2008. And coming out of 2008 till he was retired going into 2008. He was big in the single family rental space. And he started getting some calls from some of the big banks, like, we have 600 homes we want to sell to you. And he was essentially naming his price, but he built that portfolio up to, it was 25,000 homes. And he sold it off to BlackRock. This group, I had dinner or lunch with him a couple of weeks ago, and he's already made tremendous amounts of money. He's had 2 or 3 giant home runs during his career. But I was like, "What are you doing now?" I'm like, "It's especially these moratoriums." He goes, "Well, Peter," he goes, I have systems in place where it's monitoring every single county, and he can see, okay, how many of them are going towards foreclosure, how many are doing this. Now, obviously during COVID, there really wasn't much of that, but he really can track all the numbers, and he has a pulse on a lot of that. So, and he's also a partner with one of the digital brokerage companies that you see online. I'm trying to think of what the company was called, but essentially one of the big backers was Starwood, and he was the other backer. But he's going to offer people on that platform the leverage to buy these homes. So he's even going from that perspective too, but it's all through technology. And that's how he scaled.
Peter, dealing with the eviction is completely different, as all of us know. And
Yeah.
dealing with foreclosure. I mean, every court would be a lot more sympathetic and lenient toward the tenant than they would be toward the owner. It is, especially if you have a single mother, if you have a family of little children, if it is during school 9 months. So all these considerations, you and I as investors will consider, while the wealth manager is not using his own money. He's using an algorithm.
Yeah.
And
Yeah.
that makes a difference.
That's the gap, basically, between those who actually invest in the asset and those who, get the funding for the asset. That was my thing. In other words, you want to use data to help your conviction and make a decision, but at the same time, if you're flipping homes, if you're buying a home today, you have to get it at a good price if you flip it in 6 months. If you're buying top price, you're not gonna be able to flip and make money like guys at Zillow did. But at the same time, if you know the market, like you said, and you look at the data, then you make a different interpretation as a professional.
Now, there's another technology that actually underwrites renters. Credit, right? Trying to actually rent nowadays, with a bad credit score,
You can't.
you're out of luck. So that's really where actually the low-income family with the people who have not been sensitive to their credit scores are finding themselves that if they lose their apartment, they won't be able to find a place to actually live. So, we're in actually unsecured debt. We're finding that people, because of that, they're actually servicing their unsecured debt as well, paying attention to making payments. So you're actually seeing very good credit card performance for that.
But let me tell you, in New York City, they changed the rules. So when you do a credit check on a tenant, you can't just deny the tenant because he has bad credit. So it's a bit different. They are changing the rules and making it difficult on a lot of the landlords, unfortunately, between rent stabilization and the fact that you cannot use those scores to deny housing to somebody, makes it very, very
This is
difficult.
using alternative data, not the score.
No, I get it, but you still, if they get wind of it, you have issues.
So
in
what,
that regard.
what criteria can you use to accept?
You
the
can take a
record?
1 month security and that's it.
That's
You-
it, that's.
You hope that person has a job,
I'm
is in
not
school.
sure whether that's,
Go ahead, Marty.
So can you guys talk about sensitivity to interest rates? And obviously, there's this tax bill that's maybe passed, may not be passed, where it's gonna raise, the tax deductible amount to, $80,000. And just
Yeah,
give,
but that's for primary homes.
right, so just to give me perspective, so in terms of flight from states. So there was a statistic that came out in the Wall Street Journal. It said that 250,000 people have moved from high tax paying states to states like Florida, Texas, et cetera. And that represented about $30 billion of taxation, right? And of that, about 10,000 families moved, and they represented $12 billion. So it's like the highest paying people. So I mean, what's the impact of things like tax policy and interest rates on real estate going forward? In terms of what you see for next year, et cetera. Maybe talk towards that.
I can tell you that. In today's environment, we cannot analyze the impact of the interest rate without injecting in the conversation the uncontrollable inflation environment that we are living through. We cannot take one with the other. It is creating a disparity today between the cost of living and the salaries. Now, I don't want to get into social programs where we see that, and say something that in 2-3 years will be said publicly, that the middle class of America will completely be wiped out because of this, because when a dozen of eggs was $1.50, and then today it is $3.25, and then some politicians say, oh, this is a transitional inflation. I mean, I'm an economist by trade, by education and by practice. I never heard that term, transitional inflation.
Transitory, yeah.
no, this is what.
Transitory,
Transitory.
the cost of
There is a-
a gallon of gas today is $4. You expect it to be $1.99 again. I mean, you're out of your mind, because those exporting countries, OPEC or non-OPEC, they do have a balance of payments. So when we talk today, real estate is the most attractive hard asset, is because the interest rate is very low. But when you factor in the inflation that again is non-controllable, the moratoriums, we know that there will be a point where the lobbyists of the landlords and the lenders, they will win, or they will have a word in the court of law, at whatever tier of the law, until the Supreme Court, because something has to give at the end of the day. I own big buildings. I do have obligations to the elevator service, to the HVAC, to the security, and to everything else. And those bills come monthly, but the rent is not coming in.
So my cyclical thinking, getting back to what I think Rosario is saying, location, everything's local when it comes to real estate. But the issue is people don't really anticipate these political
No.
or, interest rate factors that can happen that can make everything go.
You're not gonna make decision based on tax bracket or whether they're gonna take away the salt. It should be taken away. We don't need salt. I mean, when they say, oh, blue collar workers, teachers, they can't pay $60,000 in property taxes. You can pay 15, 16, 17. And I don't think that people make a decision to move based on the tax. I don't believe so. They make decision on the lifestyle. If they can move somewhere for their betterment or enjoying life or weather or services. I mean, let's assume you leave New York and you move somewhere to North Carolina. You know how many people are moving to North Carolina? Eventually the taxes go up because they need more roads, they need schools. So that's the
It's
issue.
not the largest percentage, but of the people I spoke to, many of them moved because the schools were open.
Yeah, but look, what's his name?
But
The hedge fund guy, he's coming back, Appaloosa.
There you go.
He came back
And they
because
moved because they
they
reference to taxes, there was a white paper that was written by one of the leading top 3 law firms in New York. And it says that if you are a New Yorker and move to Florida, if you make less than $265,000 a year,
thing.
It was not worth
It wasn't
leaving.
worth it, yes.
Interesting.
Your rents could be a lot less. What factors do they use? I mean, it depends on where you're going. We're seeing people come, a lot of people come to Tampa Bay right now from New York, and they absolutely love it. I spoke to some last week, and they're probably in that bracket. Rents are so much cheaper than New York. Just that aspect of it.
Right, thing, because you're not gonna be able to go to Broadway.
It's
You wanna go see the rain.
Yeah, you have phenomenal restaurants. We have restaurants opening 24/7. I mean, we have some of the best in the country. It's not New York. It's not. But we also have beaches. You don't have that in New York. We have other things. You take some.
Pete, can I just jump in here 1 second, Pete?
Yeah, jump in, please.
Hey, Pete, we have these beautiful outdoor shacks for restaurants.
Yeah, I know. They're great. You gotta have 20. You gotta take a vaccine right when you walk in. I know.
American, you have Google and all these fintech companies and all these technology companies coming to New York City. They're
Right,
bringing,
that's the next wave, yes.
and none of these guys want to cook, they want restaurants, they want to eat out, or.
They want delivery, they're all, whatever that company.
Actually, a lot of my analysts, even though they're not coming to work, they were living in New Jersey, they decided to move back to New York City because they said now they can be in the city, right? I actually think these are transitory in my view, and I do believe it's transitory because technology, supply chain has been disrupted. A lot of it, the reason you're not getting a lot of your, I know that, for example, even any European imported water right now, if you go to Whole Foods, you will see that the shelves are empty because of the containers. You try to actually send stuff on the container to 3-4 months, locked out. So these will resolve, and I do believe the supply will meet the demand because of technology. And for that, I don't think inflation is actually, the only reason we have the inflation that every company thinks that every year they can tag on 10% on the bill, right? They just send you a higher bill, primarily in the service, primarily in the US, right? Because they just have an automatic thing, and that's why they get disrupted.
We've got like 5 to 10 minutes left. Can you guys talk about what niches are good and what niches are bad these days? Because I mean, I don't know if it was Pete that brought up assisted living, elder care. A lot of people overbuilt that in the last 10 years, and nobody's,
The
you know.
baby boomers, I mean, that's,
So can you just talk about what's good, what's bad, just, you know?
My portfolio and what I have of real estate in this country since 2014 is warehouses, mid-Atlantic, all the way to Georgia. There are more ports on the East Coast and more friendly labor laws in the East Coast than the West Coast. So every decision has a reason. Just like you said, you have to look in depth, dive in depth into the location, politically, regulatory, tax-wise, and everything else. Second thing, I was among the pioneers that invested heavily in data centers. Yesterday, someone offered me data centers in Arizona. I said, the heat in Arizona is not suitable.
And the power.
Is not suitable. My first investments in data centers were in the country of Estonia. And because the weather, the internet, the grid, the human resources, because those you service 24/7 and in different languages, remember. Because you might have clients from Saudi Arabia and a client from Ireland and a client from somewhere else that speak another language, and they need a reboot 3 o'clock in the morning. You need the attendance to be able to interact. And the next thing, you need the backup energy. And I prefer, for example, today, in the beginning, we bought because it was a new trend and we had incentives. Today, I prefer backup grid to be liquid hydrogen versus the regular butane gas. Okay, because of security, because of cost, and because of the impact on the environment. So we became more specific. Yeah. Now, when we talk about the wiring, do we have fiber optic or we have copper because of something in that business called latency? People say, okay, I want to invest in data centers. How much do you know about them? From locating them to building them, is it going to be tilt up or it's going to be solid concrete? And how are you going to do the HVAC? Because those who live inside, they are exposed to a lot of radiation, in a data center. A lot of things are being considered. The third thing, I invest in life science centers. and I invest in life science centers in 3 different locations in the United States, in the Triangle, down in the Carolina and the Temple Hill, and where Duke and everybody else, and then in Boston, and then in San Francisco and in San Diego. I know I said 3, but those 2 in California are
It's a
one.
big trend.
I'm still awake. Though, and if you go out of the United States, you invest in life science in London. Why? Because again, the specialists, the chemists, like the lady who was sitting here before, Danielle, those experts, they kind of congregate in those locations. So again, you invest in an asset because of a reason. Now, I do for Peter, I am, my first property I bought, I think I was like 22 years old in North Miami Beach that became Aventura, okay?
Oh, yeah.
Around Turnberry, yes. And before even the causeway was built, I love Florida, but during COVID, I did not go to Florida until Sunday I'm going. And I kept loyalty to my properties in New York, and I stayed in New York because I wasn't able to go back to Dubai for about 16 months. And Florida is great, but New Yorkers, many of them did not make the best move, because there is today a conversation among employers. If you worked in the company in New York, you had a level pay, okay, that's commensurate with the cost of living in that state, in that locality. Because it is cheaper, as you said, which is true, down in Florida, if you don't want to come back to work, you want to work from home, your salary is going to be adjusted.
That's right.
Yeah, but also there's also a labor issue right now where so that's kind of keeping it. They want to do that, but they also want to hire and grow their company. So they talk about it, but is it actually happening? I mean, I have buddies that work in tech. It's not happening from at least what we're seeing. I mean, there's a labor issue everywhere, so it might happen down the road, but I mean, right now it's not.
Peter, today the best thing about your state is the governor.
Oh yeah.
Wow, that's what?
How many enemies, how many friends I made?
No, he's.
Great.
He's okay.
I think again, go back to the theme of, if you follow everybody else, you're essentially going to get average return, and you're going to be subject to the volatility of that asset class. So you really need to think about value add. Where are you adding value? So therefore, we're more inclined to not looking at the existing asset classes, but what they can be. So if you have, you look at cities where essentially cities expanding, as I mentioned, Boston. There's a huge areas of Boston that were, because of the growth that Boston is getting, a lot of corporate, they've been attracted. Success brings success. When GE moves there, when all the others are moving there. In terms of life sciences, also think about life sciences globally. Brazil, for example, is offering extreme incentives for pharmaceutical companies to come in and create a campus to just meet the local pharmaceutical needs, produce locally and deliver, right? So we also seen, again, there's even in India, there's quite a number of pharmaceutical, a lot of the vaccines that are developed outside of, or sold outside of the United States, they're manufactured actually in India. So take a look at those. Those are really high tech based on a lot of these areas. So the beauty of real estate is that if you're only looking at Manhattan, you're looking at offices, hotel, and retail, you really have a very narrow perspective of what real estate is about. You're going to look at a much bigger picture. And if you want to diversify, but diversification doesn't always give you the best result. Expertise does.
But that was my point. You need expertise. Like Kamil said, you buy in a data center, you have to understand what it entails. And the same thing is, you're flipping homes. You need to understand, are you buying the house at a discount? What does it take to put in? And then when you're gonna be,
Don't think
because
about
nowadays,
buying, think about
everybody's asking
developing.
crazy money. I was looking for a house in Rhode Island. People are out of their mind because they want all crazy money for stuff that needs work. So I know the market is at the top right now. It's too frothy. for certain things, single-family homes, it's very frothy. I can make more money buying Apple stock and I don't have to worry about dealing with a tenant. That's the truth at the end of the day. So, like Kamil said, there's a point that, yes, inflation, that's fine. But if you ask in a price that it's not commensurate with the rate of return, the investment is not worthwhile because we're in it to make money. It's not a charitable event. So, and in real estate, you make money when you buy, not when you sell. That's the rule. And people, hedge fund guys, they try to change everything, showing hockey sticks and, back in 2007, showing rents on Fifth Avenue, but Bryant Park going to $200 per square foot, which is insane. We never got to 200, by the way.
The guy who created Mall of America, for example, the Mall of America was not available to buy. It was available to develop. So that's what I'm saying. If you want to buy a data center, build one in Norway with hydro energy being available.
Maybe some solar panels from Tesla. Come on.
Can we get?
Johnny, give us your opinion. Come on, before you fall asleep.
Show me the debt.
What do you think? What keeps you awake? What do you like? What do you want to put your money in?
What are the hot areas?
What are the hot areas? What do you want to invest?
Yeah, I see a lot of clients making money on industrial, making a lot of money industrial. I think the rent, I thought was too high, but he kind of explained to me that basically all the retail rent that you used to see, the high rent, is kind of switching to the warehouse rent because they basically now are running a virtual store. So that there's a lot more room to grow. And I see some clients doing doubles, triples on value. So that I think industrial is still have way to go. I have a client made a lot of money on movie studio too, and that's a very unique asset. Self-storage, my client was in it for a while, but he got out because he thinks that just too saturated. And also New York City is now, they stopped doing tax credit for the self-storage. Multifamily, I think unless you're buying it at distress, it's very hard now to really, you can make money, but it's gonna be, singles and doubles. I mean, if you wanna make big money, I think right now it's gonna be industrial.
Peter.
Yeah, so I look at risk-adjusted returns, and I think one of the most beautiful asset classes in real estate's apartments, just because it's subsidized by Fannie and Freddie, right? That gives it more liquidity. It's probably it is the most liquid real estate asset. So that's why we're focusing on our hotel conversions. We're very risk adverse, so we're buying extended stay hotels, specifically extended stay, that have the correct zoning. We're not going through the whole rezoning process because that's a big risk. And we've partnered up with a group that has the in-house personnel, has the labor, and has the relationships to get the materials so we can convert these extended stay hotels to apartments. And then after we do that, they're eligible for Fannie Freddie financing. So we're taking something, you could buy it, even if you're buying it, you buy it discounted for, let's call it 8.5%, 9% cap rate. You're putting some money into it, and you're coming in, maybe let's call it 6.5 at the lowest, typically probably around 7.5, and you're financing it with 3.5% debt, even cheaper than that. So that's a really big spread. So they produce a real opportunity for cash flow. And just given where Kamil said about inflation, which is very true, you want assets that are throwing off a bunch of cash flow. And when you have a big spread between your cap rate and your interest rate, it's a great it translates to great cash flow, and it's a great inflation hedge.
Any questions from the
I
audience?
just want to clarify, I'm not short because my chair is low.
Oh, yeah.
We're gonna adjust that on the when we release the video.
Yeah, virtually adjust. Make me a higher.
All right. Any questions? Yes.
Yeah, I was gonna say, probably identifying if you're IRR based or yield based, because it sounds like y'all are a lot of yield. Some of these families want in and out, and the IRR is what matters. I'll give you an example. My dad, who's bought a ton of single family homes, he's probably got 120 of these things in North Dallas. He's bought them in all these old down cycles, kind of like Peter, your client did, just on a smaller scale. Every one of these downturns, whether it was the internet bubble or, 9/11 or, 2008, rents just kept increasing. He never had vacancies, and it's just fascinating asset class.
And Dallas is amazing because it's only been all growth, right? I
Yeah,
mean,
maybe it's the area we're in,
you've
but
got
it was just,
100 people moving there a day, right?
Yeah.
So,
it never dipped. I mean, it just plowed through all these cycles.
Real estate, generally speaking, and if you take the New York City families, they've had real estate for a century, okay? So it's a long-term, boring game, okay? So when we talk about IRR, that means 3-5 year and you get out. But what if the market is bad? Okay, so a lot of funds, they have a finite time to get out, but the true real estate guy, like Kamil, he doesn't care. There is no anything ending at the horizon. You just keep on, you have real estate, you keep on refinancing, get your money out. Now you have nothing at risk, and that's a true risk-adjusted return because you can get your money out tax-free.
Yeah, it's tax.
Okay, now, the people that make the mistake is the ones who do the 1031 exchange. Every time they do it, they buy a crappy property.
They lose their tax benefits. They lose their cost segregation tax benefits. Do a 1031 exchange, you're losing tax benefits.
When they say 60/40, that 40 should be real estate. The 40,
yeah.
the bond, because right now it's better than government bond, and has been, classically has been. If you have medium to low leverage, that cash flow is your income. So buy growth stocks without dividend and real estate unlevered. You have the
It's
best
not easy.
portfolio.
It takes, real estate is something that.
It's a patient,
No,
yeah.
it's hands-on, like Kamil said. I have to check my guy in the store and make sure he doesn't fall asleep at the, man, it's time consuming, it takes a lot of attention to details. Even going to a building and saying, you know what, look at the paint, it's cracked, it looks terrible.
there's another
Let's
question
get
in the
it-
audience.
Go ahead, I'm sorry.
Actually, especially Sash comment, you're right, it's being pushed heavily on the street. Blackstone, Starwood, Brookfield, all private REITs now, they're taking so much money. The people I know in the industry are having issues
Why?
pricing out bid.
Sure.
Because these guys have evergreen funds, there's so much capital coming into play, that the smaller players, some of them are going into development now instead of, value turnouts and deals, because they're getting outbid constantly by the biggest players now. So what do you guys see in terms of that, in terms of either one, keeping prices inflated, or two, opportunities around them, because B-REIT pays 5%, so does S-REIT, and it goes up, 3 to 5 potential a year. It's a good asset for people who don't want to do the investments and the legwork everyone does. But like, what do you see, because they're changing the market, but like you said, big guys buying 1,000.
So our strategy in that regard is to actually create the asset and sell into it, right? I mean, the point is you see that, you don't try to compete with them, you join them. And so that's, they are not there to develop the asset. So we are right now teaming up with developers that do have, let's say, 2,000 units, 3,000 units, 5,000 units. They have their own property management, where essentially it's a leftover from whatever they develop. So, let's put that into a fund. Now you have 5 or 6 of you guys with 10,000 units, 20,000 units. We get a valuation, we sell it to them. So you gotta, in that regard, and then let's go develop some more. So it's really creating and feeding that machine that you're gonna make money instead of just going and trying to compete with them. That's not the best way to go. So that's really what we do as a asset manager we're not gonna become a developer, but there are plenty of people locally and their families have been doing it forever. Team up with them and fund them, bring the funding to them and then aggregate and sell into.
We have time for one more question.
Sure.
Last question?
So I think that it's very clear that in hard assets, kind of macro trends, including what you mentioned, Kamil, over there about political administration matters a lot. So I think there's probably a consensus that Dallas is doing very well and Florida is going through a great time. What's the other places, maybe on a lower kind of maybe county level, that you guys can share with us that you think those locations have all the right kind of aspects to become great places 5, 10, 20 years from now?
For the foreseen future, the real estate will maintain value because the interest rate is low. Two, beside inflation is the labor market. There will be a plateau and adjustment in the labor market. AI, robotics, machine learning, the Internet of Things are going to change a lot. I remember we were in a previous event with Marty about 2 years ago in a law firm on 7th Avenue. Sure. And the lady asked me a question. Is the trade tension between the United States and China going to impact the economy of the United States and labor? I said, Miss, there is a problem with what the administration at the time had rehashed. Funny enough, this administration is following the same tariff, the same regulations. But you should be more concerned, I said to her, more about robotics and about Internet of Things and machine learning, because that will affect the future of the labor market. So that will lead to the affordability. I didn't mean to go around the question, but and not to be direct now. The affordability of buying a home is going to change. We as the United States was always 12 to 14% in owning homes ahead of Europe. And I'm talking about Europe, not the peripheral, but Central Europe, economic Europe, Germany, England, France, and then Italy and Spain. And then everyone else that come as a second tier, or we call them the peripheral, the peripherals in economics. Today, the United States, I think in the next maybe 3 to 5 years, is going to match Europe, where home ownership in America will drop to about 60 to 62%, from close to 70 to 71%. And these numbers, they come from the government, come from solid resources, come from the top 4 leading accounting firms that we all know. What will happen to those portfolios? The future of after every situation like this disruption that happened, no one is an expert because none of us was alive when the last one happened in Spain in 1917.
It wasn't in Spain really. It's starting in China probably as well.
So there will be till today, the dust did not settle.
Yes.
So when you ask me about states and we know each other, I say, Kamil, I need an answer now. Don't give me a whole lecture. I say, well, look into the 7 to 9 states that don't have income tax. Definitely those will be the first.
Yeah, but you could also let's look before COVID. Let's look at a lot of those places have really, sped up. They've, gained a lot of momentum. So to give you a little bit more specifically, I'd look between certain corridors. So everyone knows Atlanta is really hot right now. Charlotte, North Carolina is really hot. So look, what's right between that? Greenville, South Carolina. That market's really on fire. You look at areas like that. You look at Savannah, Georgia is really on fire right now. Because you look at the proximity to areas like Atlanta, look at the proximity to areas like Charleston. Jacksonville is doing really well. These are all cities that were doing very well before COVID and are even doing better now. And I think a big reason for that is because they're near big thoroughfares, big highways, and also big cities. The Atlantas, the Charlottes, those type of areas. That's how I look at it. I mean, no big science behind it, but that's just, again, good areas. They have good infrastructure for it.
Pete, can I make one more comment based on
Yeah.
two comments actually? And the first comment is people say they're not building more real estate, right? That's the old saying, you don't build more real estate. But really, there's very little new infrastructure that's going to be built either. So that kind of supports your whole thesis. The second one is Georgia has a guy who's running for governor who says he's going to get rid of income taxes. Right? And if that happens, you'll see a flood of people going to Georgia the same way they go to Florida. Atlanta's got fantastic universities in Georgia Tech and Emory. So
That kind of feeds back into the thesis of Camille's and of Ron's of
How about Utah? Utah is a pretty good state.
Not coastal
Utah
United
has
States.
fantastic universities, education,
Well,
hard
well,
workers.
with coastal,
Salt Lake is, we
coastal
just-
United States will always be the most attractive.
Yeah, but they're definitely, Portland looks a little bit down now, but I think it will ultimately clean up itself. But the special opportunity zones, don't forget those. And also follow Tesla, wherever they go, make sure you got some property around them.
Last question.
Last question, no more than 20 seconds to answer.
Hey, she's panicking, take your
Hold
time.
on, hold on. So we now have digital offices, hybrid offices. Most likely, we're not gonna all come back 100% into the offices. What's happening with corporate real estate? Are companies gonna cut down on their
Office.
office space? What's that office space?
Counter question, where?
New York City.
New York City? It will adjust. The only issue today that is holding many corporations from reconfiguring their office to improve the environment for those who will come back to the office. Because remember that many corporations, they had 100 to 200 square feet per person when they lease. Today, people are demanding more than that. I will not go back to work unless you have so much. Now, the obstacle here, who is going to finance the TI, the tenant improvement? Now, normally, either through negotiation, either the landlord will give you a lower per square foot, you, the tenant, you seek the money for TI, or vice versa, okay? The tenant is not willing, and the landlord doesn't have the financials to support his ability to get any more TI, let alone servicing his current finance. So that will be the obstacle that will take some time until it is solved. When Jamie Dimon said that he is going to ask his people to come back to work, the middle of 2023, he was the first one who mentioned 23, everybody said 22. So by that time, they will have all their New York offices adjusted. So either by acquiring other assets within the proximity of Bryant Park, or
They just completed a building and building another one.
but that's Jamie Dimon. Now, not every landlord is a Jamie Dimon.
So,
But before this started, I mean, when you started, there were some of the, like RX are their big real estate owners, they own the Homsi building. Their thing was, oh no, tenants will take more space. We're gonna be able to lease more. My opinion is a lot different. There's gonna be maybe a hybrid situation, but you know what? People have to be at work, they have to be together. We cannot be like Zuckerberg, who wants people to be in the metaphysical world. He wants people to date, to have the, an avatar date. That's not gonna happen. People, we're social animals. Ultimately, we need the interaction, we need to go to places. Yes, you may need more square footage between your desk and somebody else's, but if you isolated at home, I don't think you can, yes, you can be productive because you don't commute. But can you be productive coming up with new ideas, brainstorming? I don't think so.
How about a sports arena with metaverse?
yeah, so I think we've talked in the past about the gaming, there's more than, every day in the United States, a sports arena is full of people who are watching other people do gaming, online. It's strange. So anyway, fantastic job, guys. Thanks so much. We do have a hard stop.